Happy Thursday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. US President Donald Trump's return to office has reignited uncertainty in US-China relations, with trade and tariffs once again at the forefront. Investors initially breathed a sigh of relief when Trump refrained from imposing additional tariffs on China on his first day back. However, this investor optimism was short-lived as, on Tuesday, the president reiterated his intention to impose a 10% tariff on Chinese goods, citing concerns over fentanyl trafficking. Trump hinted at a potential February 1st deadline, signaling his unpredictable approach remains unchanged. Asked about his plans to raise tariffs on China at a White House event on AI infrastructure, Trump responded, quote, "We're talking about a tariff of 10% on China based on the fact that they're sending fentanyl to Mexico and Canada," end quote. Chinese officials had braced for harsher measures, including a 60% tariff, which would have severely impacted the world's second-largest economy. Indeed, some economists believe that such tariffs could cut Chinese GDP growth by half. Instead, Beijing faces a more measured but still significant challenge. Experts like Zhao Minghao from Fudan University in Shanghai have expressed cautious optimism about potential compromises, but they acknowledge the uncertainty surrounding Trump's next moves. Past experiences from his first term underlie the difficulty of predicting his actions, with volatility being his hallmark of leadership. The financial markets have not been immune to the turmoil either. Analysts at Nomura highlight that Asian equity markets remain vulnerable to tariff risks, noting that stability may only return once the specter of tariffs is fully resolved. Chinese shares fell sharply following Trump's latest statements, reflecting the apprehension among investors and policymakers alike. Trump's approach to China continues to blend unpredictability with strategic bargaining. While he initially projects a conciliatory tone, as seen in his overtures during the Mar-a-Lago summit with General Secretary Xi Jinping during his first term, this often gives way to more aggressive measures. Chinese experts like Wu Xinbo of Fudan University caution against interpreting Trump's gestures as genuine goodwill, emphasizing that Beijing must remain prepared for heightened demands. As Trump's new Asia team takes shape, the trajectory of US-China relations remains uncertain. Some are optimistic, however. Instead of the widely discussed Trade War 2.0, Graham Allison, a professor with the Harvard Kennedy School of Government, argued during a recent panel discussion at the World Economic Forum on Tuesday that ties between the two superpowers could tick up, expressing, quote, "I'm betting this time next year we'll be surprised by the upside in the relationship. I have a piece which will be published next week that asks, is Trump a China hawk? I think if you look at what he said and did, you'll find it difficult to classify him in those terms." End quote. Others, however, argue that Beijing must navigate an environment where volatility and strategic rivalry are the new norms, and whether Trump is a China hawk or not, many in his team are, as we have seen. As veteran China analyst Bill Bishop observed today, quote, "If there is any lesson for US-China relations from Trump 1.0, it is that he is a volatility machine, and predicting what he will do is a sucker's game." End quote. So on China Update, we will not try to predict what is going to happen in US-China relations. We will just follow along closely as they happen. Next up, we move to the Chinese economy. Chinese steel industry faced a challenging year in 2024, with profits plunging by 50% to approximately $5.9 billion due to sluggish demand and market imbalances, smashing profit margins for China's steel producers. According to new data just published by the China Iron and Steel Association, revenues dropped 6% to 6 trillion yuan, $824 billion, and the average profit margin shrank to 0.71% from 1.34%. These are razor-thin margins. CISA Chairman Yao Lin highlighted the persistent oversupply and lack of self-discipline among producers in controlling capacity expansion. Brutal competition has further disrupted market order, driving the industry's ongoing decline. Yao urged enterprises to strengthen self-regulation and avoid price wars to stabilize the market. Of course, one of the issues is that this sector is heavily subsidized by the Chinese government, thus leading to overcapacity. China's steel demand has waned amid a prolonged downturn in the real estate market, with consumption dropping from its peak of 1.05 billion tonnes in 2020 to 892 million tonnes last year. Despite falling demand, production remained near 1 billion tonnes in 2024. Hence the overcapacity. Looking ahead, the government plans to bolster domestic demand through proactive fiscal measures. However, as regular viewers know, so far, fiscal measures have been quite underwhelming. Next up for the economy. After 2 years of declining shipments, China's smartphone market bounced back in 2024, with annual shipments rising 4% to 285 million units, according to analysis firm Canalys. Domestic brand Vivo led the resurgence, shipping 49.3 million units, an 11% year-on-year increase, capturing 17% of the market share. Huawei Technologies followed closely, shipping 46 million units, a 37% surge from 2023, securing... Hey, what are you doing? Hey? Hey? Come on. Apple claimed third place, while Oppo and Honor rounded out the top 5, each with a 15% share, underscoring the intense competition in the market. The rebound was attributed to manufacturers' strategic investments and technological innovations, as well as some modest demand recovery. Analyst Lucas Zhong, speaking to Chinese financial media outlet Yitai, projects that smartphone shipments in China will exceed 290 million units in 2025, supported by government-backed smartphone subsidies, a program which we covered a few weeks ago when it was rolled out. According to senior analyst Toby Zhu, speaking to Chinese financial media outlet Yitai, the market's growth is structurally sound, driven by enhanced product value, innovation, and market education. The final quarter of 2024 saw a 5% year-on-year increase, with 77.4 million shipments, boosted by peak season sales in the premium segment and national stocking subsidies. With this resurgence, these players in the highly competitive smartphone market will be hoping that this is a sign for further growth in 2025. Next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode of China Update, I have a huge favor to ask, that is just to hit the like button, and if you have not done so already and you think you would like to watch another one of these episodes, subscribing is a huge help as well. It tells the algorithm to show this to new people, it's a tremendous help for the channel, and it means you'll be on top of the most up-to-date analysis on China as it's released. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Thank you so much. And finally for today, ByteDance, the Beijing-based parent company of TikTok, is intensifying its investment into artificial intelligence infrastructure, allocating over $12 billion in 2025. This significant move highlights ByteDance's commitment to leveraging cutting-edge AI technologies for growth, despite mounting challenges, including geopolitical pressures and intensified US export controls. ByteDance plans to spend approximately $5.5 billion on AI chips in China, doubling its expenditure from 2024. Domestically, about 60% of its semiconductor orders will go to Chinese suppliers like Huawei and Cambricon, adhering to Beijing's informal guidance for technology firms to prioritize local chip makers. The remaining 40% will be allocated to NVIDIA chips, albeit restricted versions modified to comply with US export regulations. Overseas, the company aims to invest $6.8 billion in developing its AI computing capabilities. This includes acquiring advanced NVIDIA chips to bolster foundation model training, a move critical to competing in AI innovation. However, tightened US export controls introduced under former President Joe Biden could complicate these efforts by requiring stringent reviews of chip ownership and usage. ByteDance's aggressive AI expansion comes as it faces significant scrutiny in the US. Washington has pressured the company to sell TikTok's US operations. This is an ongoing saga which we've been following closely, citing national security concerns. This geopolitical tension, combined with restrictions on high-end NVIDIA chip purchases, has forced ByteDance to explore alternative strategies, including renting chips through third-party providers, an option recently curtailed by US policy changes. We also followed this last week as they were rolled out. Despite these obstacles, ByteDance has seen some success in AI development, launching its chatbot Doubao in 2023. The application has garnered 71 million monthly active users in China, solidifying ByteDance's position as a leading AI innovator domestically at least, alongside competitors like Baidu, Alibaba, and Tencent. As ByteDance pursues its ambitious AI agenda, questions remain about its long-term access to critical technologies and the impact of geopolitical dynamics on its operations. While its 2025 chip purchases are secured, sustaining growth beyond that timeframe will depend on navigating regulatory challenges and competing effectively in the rapidly evolving AI landscape. However, as we have discussed in previous episodes, one of the biggest challenges for these Chinese players is that they are increasingly behind due to their highly restricted access of the world's most advanced AI chips. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Thursday, and I will see you all tomorrow.